Today, we're looking at sensitivity analysis as a tool for capital budgeting. The focus is how we integrate both quantitative and qualitative risks into investment decisions so we're not just chasing NPV, but understanding how fragile or how robust NPV really is. Let's ground this in the basic purpose of financial management. The primary goal is to maximize the value of the firm, and by doing that, maximize shareholder wealth. We do that by marketing investment, financing, and operating decisions that increase the present value of future cash flows. We work through four core functions: capital budgeting, selecting long term budgets that add value; capital structure, choosing the mix of debt and equity to finance the firm; capital management, managing short term assets and liabilities to keep the firm liquid and solvent; and risk management, identifying, measuring, and controlling risks that threaten projected returns. Sensitivity analysis sits inside capital budgeting and risk management. Sensitivity analysis is a what if technique. We look at a project's outcome, usually NPV, and change one input variable at a time, holding all others constant. That lets us see which assumptions the decision is most exposed to. Why does this matter? It reveals which variables really drive value and risk. It shows how far an input can move before NPV turns negative. It directs management attention to assumptions worth refining. And importantly, it complements the NPV decision rule. It doesn't replace it. The chart here shows NPV sensitivity plus or minus 10% change in each input. You can see unit price and sales volumes have the largest swings, followed by variable costs, discount rate, and fixed costs. Here are the quantitative step-by-step mechanics of sensitivity analysis. Build the base case model. Establish expected cash flows and compute a base case NPV using best estimate assumptions. Identify key input variables. List the main drivers: unit price, volume, variables, fixed costs, discount rate, salvage values, and working capital. Define the range of variation. Flex each variable by a set amount, like plus or minus 10% or plus or minus 20%, one at a time, while holding all others fixed. Recompute NPV for each change. Recalculate NPV for every variation to measure the swing in value. Rank and interpret the results. Order, order variables by impact, uh, often using a tornado diagram, and find break-even points where the NPV equals zero. Each variable is tested independently so we can isolate its individual effect on value. The numbers only matter if the assumptions behind them are credible. Qualitative judgment frames, validates, and acts on the quantitative results. We validate the assumptions, pressure test each input against market knowledge, historical data, and expert judgment, confirm that the variation ranges are realistic, not arbitrary, judge which risks are plausible, distinguish variables that can realistically move from those that are relatively stable. We weigh the likelihood of each swing, not its magnitude. Plan management responses. Identify mitigations, contracts, hedging, flexible capacity for riskiest drivers, and decide which assumption needs deeper research before committing. Communicate and decide. Translate findings into plain language for decision makers and fold qualitative context into the final accept reject judgment. Internal methods use the firm's own projections and standalone project data to gauge risk. They include sensitivity analysis, Vary one input at a time to see which assumption most affects NPV. Scenario analysis. Flex several inputs together into best, base, worst case scenarios. Simulation. Assign probability distributions and inputs and models to inputs and model thousands of possible outcomes. Break-even analysis. Find the level of variation at which point NPV falls to zero. Decision tree analysis. Map sequential decisions and probabilities to value managerial flexibility. Risk adjusted discount rate. Raise the discount rate on riskier projects to demand higher return. These tools help us understand the project risk, understand project specific risk from the inside. External methods benchmark the project against the project against external methods benchmark the project against the broader market and firm's overall risk value. They include CAPM and beta use market derived data to set and require um, return that reflects systematic market risk, cost of implications or cost of capital. This discount cash flows at market-based weighted average cost of capital. Pure play comparables, borrow betas, and valuation multiples from comparable public firms in the same line of business. Market and macro scanning, assess interest rates, inflation, demand cycles, and commodity price outside the firm. Regulatory and political risk, weigh environmental rules, permits, taxes, and policy shifts that affect the project. Credibility and counterparty risk. Evaluate the reliability of customers, suppliers, and contract partners. These methods ensure that the project risk view is aligned with external realities, not just internal spreadsheets. Um, this slide shows how everything comes together in the capital budgeting decision. We estimate base case flows and NPV, run sensitivity and scenario analysis to understand how fragile or robust the NPV is, apply risk adjusted discount rate where appropriate, layer in qualitative judgment about assumptions, likelihood, and mitigations, accept or reject the project and plan mitigations for key risks. Thank you for your time and attention on this slideshow.